There is a moment in every market cycle that very few people recognize while it is happening. It does not arrive with panic, and it does not arrive with headlines. Those moments come later, when the story has already unfolded and everyone suddenly claims they saw the signs all along. The moment I'm speaking about is quieter than that and far more unsettling. At first, nothing appears unusual. Prices continue to move, traders continue to speak about opportunity, and the financial news continues its daily rhythm of explanations and predictions. Charts still look orderly. Trends still appear intact. If you were watching only the surface of the market, you might believe that everything is exactly as it should be. But markets rarely change suddenly. More often, they begin to shift in ways so subtle that most participants ignore them completely. A trade that once worked reliably begins to fail without explanation. Good news appears, yet prices barely react. Bad news arrives, and the market moves with an almost strange indifference. At first, these moments seem insignificant. Traders assume the timing was wrong or that the market simply needs time to adjust. It is easy to dismiss a single unusual day. Markets, after all, have always been unpredictable in small ways. Yet the strange behavior continues. Patterns that once felt dependable begin to weaken. Strategies that once produced consistent results start to produce confusion instead. Traders look again at their charts, convinced that the logic must still be there somewhere, waiting to be rediscovered. But the logic has already begun to fade. In the markets, the earliest warning rarely arrives as fear. It arrives as something far more difficult to recognize, a quiet and uncomfortable sense that the environment has changed, even if no one can yet explain exactly how. Experienced traders sometimes describe this moment in the same way, not as panic, not as collapse, but as a strange feeling that something about the market no longer behaves the way it once did. I've watched financial markets long enough to notice that this moment appears more often than people realize. It appeared before the crash of 1929. It appeared again before the panic of 1987. And in quieter ways, it revealed itself before the crisis of 2008. In each of those moments, the warning did not arrive through headlines or dramatic events. It arrived as confusion, small fractures in the logic that traders had trusted for months or even years. My name is Edmund Hale. I am not a trader, and I am not here to offer advice. I am simply a chronicler of markets, someone who has spent years observing the strange patterns that repeat themselves across generations of investors. And in this chronicle, I want to describe that quiet and dangerous moment, the moment when the market begins to behave in ways that no longer make sense. Because history shows that when the logic of the market begins to disappear, something important is often about to happen. When the market begins to change, it rarely does so in a dramatic way. There is no sudden signal, no clear announcement that the environment traders have grown comfortable with is about to disappear. Instead, the change begins quietly, almost invisibly, hidden within the daily movements that most people consider ordinary. At first, the signals appear small. A familiar strategy produces an unexpected loss. A stock that once reacted strongly to positive news suddenly barely moves. Another company releases disappointing results, yet the market seems strangely unwilling to punish it. For many traders, these moments pass almost unnoticed. Markets, after all, are never perfectly logical. Small inconsistencies appear every day, and most of them mean nothing at all. It is easy to assume that the strange movement will correct itself tomorrow. But then tomorrow arrives, and the pattern repeats. Another trade fails in a way that feels unusual. Another piece of news produces a reaction that seems weaker than expected. Slowly, almost imperceptibly, the rhythm of the market begins to change. This is when experienced traders begin to feel something difficult to explain. Not fear, not yet, but a quiet sense that the environment they have been trading in may no longer behave the way it once did. The strange thing about markets is that they often reward confidence for long periods of time. When a trend persists for months or even years, traders begin to trust the patterns they see. Strategies that once required caution begin to feel routine. Decisions that once involved uncertainty become automatic. Success slowly turns into expectation, and expectation gradually turns into certainty. In these moments, confidence spreads quickly. Profits attract attention. Attention attracts new traders, and new traders bring fresh capital into the same trades that have already been working. Each successful movement in the market reinforces the belief that the trend is strong and that the opportunities will continue. But the longer this cycle continues, the more fragile it becomes. Because when confidence grows strong enough, caution quietly disappears. Positions become larger. Risks that once felt uncomfortable begin to feel acceptable. Traders begin to believe that the market has become understandable, even predictable. Yet history shows that this is often the exact moment when the structure beneath the market begins to weaken. The signals are still subtle, and most participants continue to believe that the trend remains intact. But beneath the confidence, small inconsistencies are beginning to appear. Movements become slightly less predictable. Reactions become slightly less logical. And the quiet confusion that first appeared only occasionally begins to surface more often. At this stage, the market has not collapsed, and the trend may still appear strong. To the outside observer, nothing seems truly wrong. But to those who are watching carefully, something important has already begun to change. History has shown many times that markets rarely move in straight lines forever. Every long period of optimism eventually reaches a point where the confidence that supported it begins to weaken. Yet the most interesting part of this process is not the collapse that follows, but the quiet period that often comes before it. Long before the crash of 1929, the atmosphere surrounding the American stock market was filled with extraordinary optimism. Newspapers spoke about a new era of prosperity, an age of industry and innovation that seemed capable of producing endless growth. Investors believed that modern finance had created a kind of stability the world had never known before. For a time, the market appeared to confirm that belief. Prices climbed steadily, fortunes were made quickly, and stories of successful speculation spread across the country. To many observers, the market no longer looked like a place of risk. It looked like a machine designed to produce wealth. But even during those confident years, certain experienced traders began noticing strange inconsistencies. Stocks that had once reacted strongly to positive news sometimes moved only slightly. Other companies, despite disappointing reports, seemed almost immune to selling pressure. These moments were easy to dismiss. After all, markets were still rising. The broader trend remained strong, and the belief in a permanent era of prosperity was too powerful to question. Decades later, a similar atmosphere appeared again during the months leading up to the crash of October 1987. The market had experienced a powerful rise, and many investors believed that new financial strategies had made trading more efficient and less dangerous. Complex systems designed to manage risk were widely trusted, and confidence in the market structure was stronger than ever. Yet beneath the optimism, subtle signs of instability began to appear. Movements in price became faster and less predictable. Certain trades that once behaved reliably started producing unexpected results. Some traders noticed that the market seemed unusually sensitive to small changes, reacting with sudden bursts of volatility that did not quite match the news driving them. Once again, these signals were not enough to change the prevailing belief that the market remained fundamentally strong. The same pattern revealed itself years later before the financial crisis of 2008. Housing prices had risen steadily for a long time, supported by a complex financial system that appeared sophisticated and secure. Banks created new instruments designed to distribute risk across the global economy, and many believed that these innovations had made the system safer than ever before. But even then, the market occasionally behaved in ways that seemed difficult to explain. Certain assets began to move independently from the broader economic story. Small disruptions appeared in places that had once seemed stable. Few people recognized what those signals meant. Because when confidence becomes widespread, it becomes difficult to imagine that the conditions supporting it could ever disappear. And so once again the warning arrived quietly, not as panic, not as collapse, but as the strange and unsettling moment when the market began to behave in ways that no longer made sense. When the logic of the market begins to weaken, the reaction of most participants follows a pattern that has repeated itself throughout financial history. Instead of stepping back, traders often move closer. Instead of reducing risk, they search for ways to regain the sense of control they once had. At first, the change is subtle. A strategy that fails once is tried again with slight adjustments. A trader increases the size of a position, convinced that the previous loss was simply poor timing. Another adds to an existing trade, believing that the market will soon return to the pattern that had worked so reliably in the past. In calm markets, these decisions sometimes succeed, but during moments when the underlying structure has already begun to shift, these reactions can quietly increase the fragility of the system. Confidence encourages action, and action encourages commitment. Once a trader has committed to an explanation for the market's behavior, it becomes increasingly difficult to abandon that explanation. Each new price movement is interpreted through the same framework that once produced success. But the market is rarely obligated to respect the logic of its participants. As more traders attempt to force the market back into familiar patterns, the environment begins to grow increasingly unstable. Small movements in price create stronger reactions. Positions become crowded as many participants begin trading in the same direction, relying on the same assumptions that once appeared reliable. This creates a quiet tension beneath the surface of the market. For a time, prices may still appear stable. The trend may continue, and optimism may remain the dominant narrative in financial conversations. Yet the balance supporting that trend is no longer as strong as it once was. Conversations among traders begin to change in subtle ways. Where there was once excitement, there is now a quiet edge of frustration. Analysts produce more explanations, each attempting to restore a sense of clarity to movements that no longer seem entirely logical. But clarity does not return. Instead, the inconsistencies become more frequent. Certain sectors begin to move independently from the broader market. Volatility appears suddenly and without clear cause. Traders who once acted with confidence now pause before placing orders, sensing that something about the environment has shifted. It is during these moments that the market becomes most fragile. Not because it is collapsing yet, but because the confidence that once supported it is now resting on assumptions that no longer reflect reality. And once that confidence begins to weaken, the next phase of the story is rarely far away. The breaking point rarely arrives with the clarity people expect. When markets finally begin to move with real force, the change often feels sudden only because the earlier signals were ignored for so long. What appears to the outside world as an unexpected collapse is usually the final stage of a process that has been unfolding quietly beneath the surface. By the time this moment arrives, the confidence that once supported the market has already begun to weaken. Traders who previously acted with certainty now hesitate. Investors who once held positions comfortably begin watching the market with growing attention. The same movements that once felt predictable now appear uncertain, and uncertainty spreads quickly in an environment built on confidence. At first, the shift may appear as nothing more than volatility. Prices begin moving faster than they did before. A small wave of selling produces a larger reaction than anyone expected. Traders reassure themselves that such movements are normal, that markets have always experienced moments of turbulence. But the turbulence does not disappear. Instead, it begins to spread. A sector that had once been strong suddenly weakens. Positions that once felt easy to enter and exit become more difficult to unwind. Liquidity that once seemed abundant begins to thin, and trades that once moved slowly now move with surprising speed. In these moments, the market begins to behave less like a steady system and more like a crowded room where too many people attempt to leave at the same time. One trader sells to protect a profit. Another sells to limit a loss. A third reacts to the sudden movement itself. Each decision appears reasonable on its own, yet together they create a momentum that few participants can control once it begins. Then the movement accelerates. Prices fall faster than expected. Stop orders trigger across the market, forcing additional selling. Traders who once believed the trend would continue now rush to reduce their exposure. What began as confusion transforms almost instantly into urgency. And urgency soon becomes panic. To observers watching the headlines, it appears as though the market has collapsed without warning. Commentators search for explanations, pointing to news events or policy decisions that may have triggered the sudden movement. But those explanations rarely capture the full story. Because the true warning did not arrive in the moment of panic. It arrived earlier, during the quiet and unsettling period when the market first began behaving in ways that no longer made sense. By the time the collapse becomes visible, that warning has already passed. When the panic finally fades and the market begins to settle, people often look back and search for a clear explanation. Newspapers analyze the events, economists debate the causes, and traders reconstruct the timeline in an effort to understand exactly what happened. Yet, the explanations that follow a collapse are often simpler than the reality that produced it. A single policy decision may be blamed. A geopolitical event may be identified as the trigger. Sometimes the narrative settles on a particular moment when everything appeared to change. But markets rarely transform because of one moment alone. More often, the collapse is simply the final expression of a deeper shift that had already begun long before the headlines appeared. By the time panic spreads across the trading floor, the structure that once supported the market has already weakened in ways that most participants failed to notice. And that is why the earlier signals matter so much. The strange days when the market stops reacting the way it once did, the quiet inconsistencies that appear in price movements, the subtle sense among experienced observers that the environment no longer behaves according to the familiar logic traders had trusted for months or even years. These moments rarely attract attention. They do not appear dramatic, and they are easy to dismiss as temporary noise. Yet history shows that they often represent the most important warning the market ever provides. Not a warning of immediate collapse, but a warning that the conditions supporting the current trend may already be changing. Those who learn to recognize these quiet moments gain something more valuable than prediction. They gain awareness, an understanding that markets move not only through price, but through the behavior and expectations of the people who participate in them. Confidence can build a market, but when confidence begins to weaken, the change often begins quietly. My name is Edmund Hale. I am not a trader, and I do not offer advice. I am simply a chronicler of markets, someone who observes the patterns that repeat themselves across generations of investors. Thank you for listening to this chronicle.